Hello, everyone. My name is William Mucker. I am a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, How to Beat the Banks at Their Own Game with Ivan Zhang, co-founder and CEO of Pennyworks. I'd also like to thank you for joining us today, Ivan.
Thank you for having me.
Of course, as a quick note, Ivan will be answering questions live for this presentation. I will be monitoring the Q&A portion of the chat and posing those questions to Ivan when the questions come through. So please be aware to use the Q&A function of your Zoom. They will be, sorry. And before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you, Ivan.
Thanks, William. I'll start sharing my screen now. So today's presentation is about how to beat the banks at their own game. And it's a very interesting one because a lot of times people think that the banks are doing something magical or there's some kind of secret that they have access to that most people don't, and therefore they're able to make a lot more money. And in some sense, it's true. They are banking is a heavily regulated activity, and they have banking licenses. But the lending activity that they do is fundamentally pretty straightforward. And I'll show you in this presentation both how it works and how you can partake in it. So similarly, we also have a disclosure. This is not an offering to purchasing securities. Please consult your tax or legal advisor or financial advisor. And this is, a lot more disclosures at the full site, pennyworks.com/disclosure. And here it's just for information and educational purposes only. So overview, that's not coming out as well. Let's look on this deck. So Pennyworks was founded in 2021, and we've been in the financial management business for over a decade, not specifically in crypto until 2021, but previously we've had senior executive roles in financial institutions, including large banks, as well as proprietary trading firms. So why did we decide to embark on this journey and start Pennyworks? Part of the reason is the unique environment that we're in today. Essentially, fixed income has observed a straight line kind of up, which also means the yields have been incrementally lower in the last few decades, except for the recent past. And a lot of people have been retiring and trying to see how they can generate a source of dependable income. But if you want rather higher yields, you're faced with some challenges. Either you have to take some market risks, which means that your principal value could go down, or you have to take longer term commitments, and that means that your money is locked up for a long time. Or you have to take significant amount of credit risk, because without credit risk, you're not able to get those credit spreads. And lastly, if you want to do something extremely stable, well, obviously, cash accounts, the banks have traditionally not been able to deliver. So it's been a problem where a lot of people's money has been stuck in a very low yielding, not very productive environment. So what can you do about it? The challenge here is that most of the funds here that want to have this low amount of market risk are typically invested in money market funds, bank deposits, or treasuries. And these markets have been huge. So you think about it, you have nearly $40 trillion plus that traditionally been earning next to nothing in yields. And that's exactly the lost opportunity that has been basically each individual investors have had to deal with in the last few decades. So what can you do about it? It's very difficult. This is a chart of the percentile distributions of amounts in transactional accounts per percent, based on certain percentiles. So you can see that this amount has been going up. This is a survey that's done on a 3-year basis. It's released on a lag, so we don't have the 2022 numbers yet. But what's interesting that it's been growing even before the before COVID and the massive amount of financial stimulus that the government has injected into the economy. You can see that the top decile of accounts have hold more than $70,000 in transactional accounts, largely because of the issue that we talk about. There's not great amount of opportunities, and you're not really earning a lot of yield. And this is a very unique phenomenon. So this is a chart that goes back all the way to the 1960s. You have two quantities. On blue is the CPI measure of inflation. In the red is the US 10-year Treasury yield. So the idea here, what you notice is that the red line is essentially consistently above the blue line, with very few exceptions. And even in periods that have been some overlaps, the idea is that when you buy a Treasury, suppose you bought something in 1980, at 12.5% yield. That's a 10-year Treasury. You're going to get 12.5% for the next 10 years. But you notice how inflation is really a point in time measure. So that means that you're earning at least 12.5% from 1980 to 1990, while inflation actually drops very quickly to 5%. So you're earning nearly 7.5% in real yields with just buying Treasuries. So despite the fact that inflation has been coming down and yields have been coming down, buying 10-year Treasuries and just buying a whole has worked out fairly well for the last, I would say, 40 years until today. Now you see that this chart here only goes up to late 2021, but essentially you have this pattern that is even more egregious than in the late 1970s and 1980s. You have inflation that's almost touching double digits, and Treasury yields are essentially not even touching 4%, especially 10-year Treasuries. So that means that you're losing close to 5% per annum, and with the potential to lose more unless the situation improves. So while that's happening, are banks responding to this issue? Are they increasing the amount that they're paying on their checking account or savings account? And unfortunately, the answer is no. If you look at this y-axis, these are percents. So this 0.04 doesn't mean 4%. It actually means 400th of 1%. So essentially, banks realized, hey, look, we have a captive audience. These are folks that are not going to move their deposits, regardless of how much we charge or how much we offer in terms of savings rate. So we're just going to keep it rock bottom. And that's despite the fact that the central bank's been raising rates at a very aggressive clip. So you can see that where is that discrepancy? Well, all that excess money just goes to the banks. So what can you do about it? Well, I want to introduce you guys to stablecoin lending. This is a new product that did not exist in the last few years. So definitely there is some education and barriers to entry to be acquainted. But fundamentally, you can think about it as the same activity that banks are doing. They're lending to folks for them to finance purchases. But typically, banks require some kind of security. So they have a house, they have a car, maybe they have a business with cash flows or some other claims to it. And against those claims, you're lending out essentially dollars. So if you're doing dollar lending, dollar funding, dollar fixed income, what are some alternatives that you should be comparing to make sure that you're getting a good deal? So some of the other products that many folks are probably familiar with, securitized notes, fixed income funds, or crowdfunding of potential equity or debt securities, or even bank CD. Each one has specific characteristics. Part of the issue is that most of these private investments are typically not liquid. And the ones that are publics, for example, fixed income funds, you're taking market risk because it just ticks up and down as a function of rates. And a lot of these investment vehicles, because as you've seen, there's trillions of dollars sitting on sidelines, we don't provide as high as the yield we'd like to. So the idea is that we want to find something that is essentially middle ground, provides key features, particularly the daily access to cash and low market risk, while maintaining a decently high yield. You'll notice here I talk about this FDIC insurance. A lot of people focus on that in terms of FDIC insurance because they think that it works just like a bank deposit, and functionally it does. But unfortunately, there's no regulation right now that would allow such a product to be FDIC insurance. Banks are not allowed to actually engage in this activity, and these are the entities that typically are only allowed to get FDIC insurance. So how does this work? This is the actual business that banks do to generate most of their money, collateralized lending. And the reason they do collateralized lending is the safest form of lending. Something happens, you just take the collateral, you sell it, you get the money back. So this is exactly what we're doing here, except that this is using a 21st century blockchain technology. The investor funds with Pennyworks. Pennyworks will then take those funds, convert them into stablecoins, which are just dollar representations on a blockchain. And then there are these lending platforms similar to Lending Club or other potential peer-to-peer or other types of marketplaces where lenders and borrowers meet. And these borrowers, in order to get the loan, have to collateralize with digital assets. And when I say digital assets, I mean Bitcoin, Ethereum, some of the largest and most established tokens. And the reason for that is because these are very liquid, heavily traded, and makes it very easy for you to liquidate and get back your principal. So in exchange for them to put out the collateral, they're getting out additional cash. They can use it to fund their purchases, whether that could be a house, a car, or maybe even for other trading activities. And we get some interest at the end. Whenever you need the funds again, well, or the borrower pays back, the operation happens reverse. They pay back the funds. We get back the collateral. The funds are converted back from stable coins to dollars, and then the dollars get sent back to you. And the biggest concern that people have with collateral lending is that, well, what happens when people don't pay? And that's kind of the most straightforward issue that you have to deal with, especially since in the digital asset space, you don't need to check credit. You don't need to have known the person or the customer. It's really more about the quality of the collateral, which is entirely based on the ease of liquidation of these digital assets. So when they deposit collateral, they can obtain a loan. And once they pay back the loan with interest, they get the collateral back. And so that's all managed by the decentralized lending platform, these DeFi lending platforms here. And of course, when they don't pay, or as a result of non-payment, if the amount of collateral falls below the necessary thresholds, the lending platform liquidates their loan. And as a result, the lending platform gets back the principal and then pays back the original lenders. So that's what collateralized lending is in a nutshell. The closest analog to this in the traditional finance would be stock margin lending. This is a business that is quite profitable for most banks. It's called prime brokerage. A lot of hedge funds essentially open up these fancy bank accounts with banks, and they are able to get balance sheet or basically get loans against the trading assets that the hedge funds would be doing. And they charge a fee. And the nice thing about that is if the hedge funds don't pay or somehow are not able to pay, they take the collateral, they sell it, and they get back their money. The only thing that's different from that setup as opposed to digital asset lending is that banks are only able to sell these assets only when markets are open. So most stock markets only open 18% of the time. They're not open late at night, early in the morning, and they're definitely not open on weekends. Whereas digital assets are traded 24/7 with the volumes in excess of $20 billion a day. So this is essentially all of the mechanics that at Pennyworks we would be doing if you were to do this yourself. You can definitely manage all the mechanics that we've shown above. But essentially, the simplification, or if you want to be a little bit lazy about it, Pennyworks is the legal entity that stands between you and this activity. We will manage all of the actual lending out, and as well as the collateral, the shuffling, and so on and so forth. And at the end of the day, it just looks like a cash account to you. is compliant with the securities laws, and you get a 1099 at the end of the year. So it looks and feels just like a savings account. It's just that the mechanics of how the income is generated is directly through the blockchain, as opposed to banks doing intermediation and lending. So essentially, you're basically undertaking the same activity that the banks would be doing, but cutting out the middleman. And that's why you're able to get the meaningful yields. And similar to a regular cash account, you'll be able to have a web page and a web app you can check out that will tell you how much interest you're getting paid. The interest gets accrued on a daily basis, so you can essentially see your money working every day. So the mechanics in terms of you as an investor, how would that look like? Well, it would be very similar to just about any other investment that you've done. If you've already done investments through Camera Plan or other IRAs, it would be essentially you fill out some forms, you send us ACH or wire, and essentially then we will be able to do the rest of the management for you. So you do step 1, we do step 2, 3, 4, and 5. Any questions so far? All right. So what's our background and why are we excited about this? So previously, we worked in many facets of finance. DRW is a trading firm that essentially did high-frequency options market making. Prior to that, I was a senior portfolio manager at Bank of America, and we managed a fixed income portfolio, which was almost about 20% of the bank's assets. So fixed income is kind of our bread and butter. And when we were able to see the opportunity of combining the expertise that we had in fixed income portfolio management with digital assets and blockchain technology, this is kind of why we started this company. So the opportunity. Yes.
Not sorry to cut you off, Ivan. We do have 2 questions that came in.
Sure.
So one question from James is this regulated as a security, or is this a loan we are making that is not considered a security?
It is considered a Reg D 506C private offering. It is regulated as a security as a result of this. It is just a private security. It is debt security, so it is not equity. So what we're doing is, if you go on our website, you're seeing essentially the short-term rates that we're paying you. And these are floating rates because we're getting floating income on the other end. So whenever you like it, you can put funds in. If you don't like the rates because you have better opportunities elsewhere, you can pull the cash out whenever you want. So there's no lockups and there's really no commitment. It's really just about you being able to get the best of DeFi without having to do any of the work.
Perfect. Thanks for that answer. The second question from Benjamin is, how is this any different from Celsius and BlockFi?
So it's very different from Celsius and BlockFi. Unfortunately, the name and the industry is everyone gets commingled together. So the way that Celsius and BlockFi have typically done their operations is that they are the ones. I'm gonna go back to this diagram. So Celsius and BlockFi, they're really just traditional lenders that are focused on the crypto sector, so to speak. So you see how in this diagram, we essentially only participate as a lender on these DeFi lending platforms. 100% of our lending activity is done through these DeFi lending platforms, which means that a lot of the collateralization management and the liquidation happens automatically. There's no relationship. There's no like sales managers to call. There's no like, hey, look, you're gonna get a margin call. We're gonna give you 24 hours to give us the money or so on and so forth. It is 100% automated, which dramatically reduces operational risk as well as market risk. Celsius and BlockFi are traditional lenders, so there is none of this DeFi lending platform here. They take your money and they will lend it to maybe like a crypto mining company. And this will be a traditional firm. They have cash flows, but their assets is a crypto mine. So that's like equipment, warehouse, some things like that. Those are not things that you can liquidate within a day. But unfortunately, what they do is like they say, well, look, you can fund your Celsius account and then we'll just give you a yield and you can take it out anytime. So fundamentally, there is a mismatch between the duration or kind of the term of the liabilities, which is the funds that you would give them, versus the assets that are producing this income, which is, essentially the mining facility that is generating cash flows. Okay, well, what if the mining facility doesn't pay? Are you going to able to take over the mining facility, sell it out tomorrow, and get back cash to the investors? The answer is no, right? And that's where you fundamentally will get a problem, which is like a run in the bank, classic banking 101 issue. The reason we don't have that is because you're able to pull out the funds at any time is because these lending platforms are extremely short term. The loans essentially happen block by block every 15 seconds. So the two dimensions that we are materially different from most of these platforms is, one, we rely 100% on blockchain technology. Crypto assets draw down from a peak in the beginning of 2021, end of 2021, sorry, all the way down 70%, and essentially none of these platforms have lost money if you were using these DeFi lending platforms. We've been in operation since April of last year, and we've had no issues. But if you were a traditional lender and you had to hope that you call the guy and they'll just give you enough collateral, that's when you run into trouble. And even worse, if they were not even a trading firm, but they were doing some long-term productive assets, there's no way for you to liquidify those assets and get back the funds back to the original investors. So that's how we differ. And as a result of that, Celsius and BlockFi are no longer around.
Perfect. Thanks for that answer again, Ivan. So it looks like we have another follow-up to the initial question from James.
Sure.
He says, so then one, is this only for accredited investors? And two, is this legally a purchase of membership interest in a debt vehicle that thereafter makes loans, and are the loans then pooled, hence the security designation?
So it's not a membership interest. This is directly a promissory note. So it is a security. You would be essentially, when you're funding, what you're doing is purchasing these promissory notes from the Pennyworks wholly owned subsidiary that essentially is focused on just this activity. Yes, and as a result of the fact that it's a private instrument, this is limited to accredited investors through the per the requirements of the 506C clause.
Thanks, Ivan. That's all the questions we have at the moment.
Great. So these are very great questions, and I think that's really happy to be able to answer some of them. So if I just pretty much is the end of the presentation, just want to introduce some of our background. We both ran a megawatt crypto mining facility as well as been in finance for a very long period of time. So the activity that we're doing right now, is in terms of the product, is essentially the perfect combination of those two expertise. My co-founder is similarly involved, both in terms of the risk management side, but also more on the regulatory side. So between the two of us, we cover pretty much most of the higher level functions of the bank. So we have a 360-degree view of, in terms of both this business as well as the traditional finance, where some of those ideas came from. And that's about it. We have a little video of this, but I'm not sure it's gonna, the sound will come out. So I think I'm happy to share this deck, and you guys can check it out once at your leisure.
Perfect.
So thank you very much.
Thanks, Ivan. We do have another question. I believe you said that this was only for accredited investors, correct?
Correct.
Okay, so that was a question from Mark. Now, how would this work if you were to do it out of an IRA?
Exactly the same thing. It's fundamentally, there is a form where you would basically, for example, say, hey, look, a Camel plan is essentially the custodian that would be sending the funds. So it would be something like, Camel plan, FBO, Mark or something like that. But the mechanics of this is essentially the same. So the only difference is that you just not have to pay any taxes on this until you withdraw from the IRA. So it's more like your IRA is putting it into this investment, similar to if your IRA was investing into any other private security. It's exactly the same mechanics.
Perfect, thanks. And to add to that, if you do it from a Roth IRA, you've already paid your taxes, so you won't have to pay those taxes when you take it out.
That's right.
That's another benefit. We have two people asking, Michael and Mark are asking, what level of returns do your typical clients receive?
So this is published on our site, pennyworks.com/rates. Currently, we're anywhere between 4 to 6%, depending on the amount that you place into the investment.
Perfect. Another question. What is the fee structure and where are the loans being made? Is this transparent to us? What the money is invested in to gauge risk level and collateral?
Yeah, so there's absolutely no fees on our platform. You can check it out on pennyworks.com. Essentially, everything is rolled into the yield. We're trying to earn just a slightly higher spread versus what we're offering you guys in terms of the weighted average yield. The DeFi platforms that we actually use are 100% transparent because they're open source, which means that anybody actually can expect 100% of all the activity, and we list what those are on the website as well. So it's more clarity that you would possibly be able to get if this was a bank.
Perfect. Appreciate that answer. Any more questions from the attendees for Ivan while we have him live? Sure, spread is a fee. Do you have a set spread, or what is the average spread you are seeing right now?
So we're trying to target anywhere between 1 to 2%. The reason is the fee, the loans are variable, so our income is floating on a day-to-day basis. In fact, on a secondly by secondly basis. But we only adjust our fees on a maybe monthly or bi-monthly basis, just to make it easier for our users to see what they're generating over time.
Thanks for that answer. Let's see. Do we have any more questions for Ivan? Ivan, any questions that you generally receive that weren't necessarily covered by any of the questions asked during the presentation that you think might be useful for us?
Yeah. So maybe not emphasized. I haven't emphasized this, but there's really no lockup. So it's not like you invest in this as a private security and you have to wait for like a year. This is pretty much you invest in it, and if you want it, 2 weeks later, you get the money back. So the benefit of this and the reason why it's unique is really the fact that you do have daily access to cash. So for example, actually, there might be a typo here. So Bank CD, you would not have daily access to the cash because you have to commit to a certain term, right? So in fact, most of these crowdfunding and private securities will not have that feature. So that's kind of the key differentiator. It's pretty much as close as possible functionally to savings or checking account, but obviously we're not a bank and we're not regulated as such, so there's no FDIC insurance.
Awesome. Another good question. If somebody has questions for you after the presentation that may not have crossed their minds at the moment while we had you live, or are watching the recording and have questions for you then, how could they contact you?
Very straightforward. Ivan at pennyworks.com, or you can just reach out to our social media platforms. We're pennyworks _ Twitter. We're pennyworks on LinkedIn. We also have Instagram. Once you reach out to any of those platforms, those questions will be percolated back to me at some point.
Perfect. So Pennyworks on social media platforms and Ivan, IVAN at pennyworks.com.
Yep.
Perfect. Thanks. Edward asks, what's the term that provides the 4 to 6% yield?
So what do you mean? These are basically daily, so there are no terms.
Okay.
Yeah.
Understood.
The yields are different based on the amount that's invested. So there's a chart. If you go to pennyworks.com/rates, you'll see what we publish, and that's where what you see is what you get, pretty much.
All right, perfect. I do not see any more questions coming in at the moment, but I appreciate the wealth of information you were able to provide to us and answer our questions. If anybody has any questions about Pennyworks or how any of this works, Ivan just gave us his contact information, so please feel free to reach out to him. If you have any questions about how it applies to your self-directed IRA, how Camaplan can help you facilitate that transaction, any of our fees, or any questions at all about self-directed IRAs, please feel free to reach out to us at camaplan.com, or you can reach out to me directly at 215-283-2868 or W Mucker, M as in Michael, UCKER at camaplan.com. Thank you again, Ivan.
Thank you. Thanks, guys.
Have a great rest of your day, everybody.